So jumping right into the jargon bin. And again, it's a new series that we're doing, a part of the Gray Report, where we're breaking down these terms, industry terms that get thrown around. We use them interchangeably we use them all the time, just in passing. We just describe other things, all these, pick your term, DSCR, NOI, cash on cash, the list goes on. So we're trying to break these down every single week to help everyone have a better understanding. Again, whether you've never heard these terms before, or you want to have a little bit more of a nuanced understanding, or understand how we see these terms, that's what we're here to do.
This is a great week for the Jargon Bin. We focused on terminology, but we're actually going to compare two terms in this week's episode of the Jargon Bin, comparing the internal rate of return, or the IRR, along with the equity multiple. And so those are, two kind of return metrics in regards to investments, specifically in multifamily. When we bring a product out, we are advertising or marketing to our investors or our equity partners what the deal would look like on the surface relative to the overall returns or projected returns that an investment may have. Routinely, we get asked all the time, hey, what's the IRR? Or, hey, what's the equity multiple? It's really just kind of a quick screen as to the overall financial health or the opportunity to generate a return for our investors. Here internally, we prioritize equity multiple, but there are investors that otherwise are prioritizing IRR. And so I'm excited to kind of jump in, compare the two. So let's go ahead, let's get started just on the base layer of understanding an equity multiple. How would you define that to somebody that's hearing that term for the first time?
Yeah. Let's start with the equity multiple. Because again, these two terms I think are probably the most misunderstood and can kind of get swapped. So very simply, equity multiple, very simply, is how many times did I get my money back? If I invest $1 and it turns into $2, I have a 2x equity multiple. Times that 1 times the multiple of 2 equals 2. So expanding that out, adding a couple zeros, your $100,000 turns into $200,000. That's a 2x multiple. And that includes, specifically with a private equity investment like multifamily, that includes all of the cash flow. So it's not just your proceeds from a sale. It's all adding up all of the distributions that you've received over the lifehood of that investment, adding it all up. And so you basically take all the money that you received divided by the money that you've got or that you put into the deal.
So it seems like a relatively simple math equation of the initial investment amount at the very end term, when that investment closes, how much money you end up with in bulk. What multiple would you have to apply to that original investment amount to then get to that end number of dollars that you received?
If I put 1, I get 2, it's a 2. If I put 1 and I get 3 out of it, it's a 3. Simple as that.
Very simple. The internal rate of return, or IRR, is just another return metric that we use to quantify the returns generated through an investment, specifically in multifamily real estate. At the basic level of understanding of the IRR, or internal rate of return, what does that mean to you, and how might it differentiate from the equity multiple?
So this is where people get caught up, and it can be confusing. If you want to look at the formula for IRR, it's just this long formula. The easiest way to explain it, it's more of a time-based metric, and it's how fast did my money grow while it was invested? Not just what I got back, but when. That makes sense.
Yeah, so let's just say the investment it's a 10-year time frame over the investment. There could be moments in that 10 years where you have increased cash flow, or there's an opportunity for you to receive more funds. And then in the later half, maybe it slows down. So it's kind of taken into the account in this equation that if you look up, it is taken into account how fast you're receiving or how slow you're receiving your returns.
Exactly. So like an early refinance in a project or a bulk of cash flow distributed early will impact your IRR and produce a higher IRR. Whereas an equity multiple, the timing of the cash flows don't matter. You're just summing up all the cash flow that you've received. And so IRR can tell you of different attributes and get into more nuanced return profile than equity multiple. At the same time, IRR is more easily manipulated because of all those time-based inputs. So that's why some investors love IRR, some people hate it, and that's why some investors really like equity multiple, because it takes all the timing out of it.
Right. I can feel us wading into some deeper waters here and staying in the shallow end just briefly. Equity multiple is how much money you've made versus the internal rate of return is how fast that you made it.
Exactly. 100%.
Let's continue, wading a little bit into the deeper waters in regards to the equity multiple versus IRR. You know, you mentioned that the time weighted nature of IRR. Can you walk me through, and you said it's more easily manipulable or manipulated. What about IRR would maybe attract an investor in regards to an overall investment that maybe equity multiple wouldn't?
Yeah, so getting a higher IRR is going to typically be related to a shorter term investment. So if you're looking to really recycle that money in a shorter period of time, and that you don't really you're not as concerned about your true total return, but like what's the most efficient use of my invested dollars, you might look at IRR. So a lot of like value add investors who are looking for maybe a shorter investment horizon might focus on IRR to achieve a 20% IRR, for example. A 15% IRR is the typical target of kind of private equity investing, whether it's real estate or whether it's preferred equity. But if you wanted to have like a shorter time period and get to a 20 IRR, 30 IRR, those are the types of deals where you might look at a 1 to 2 year hold period to achieve. Achieving anything above that over a shorter period of a longer period of time is very difficult to do. And so if you're a longer term hold investor, you have a long time horizon, you might not be looking for a higher IRR, something that's more in the middle. But really, if you have a longer time horizon, your focus might be more on the equity multiple rather than the IRR. You're looking for your total dollars. I want to take that $100,000, turn it into two. I'm less concerned about like when that happens. You might say I want it to happen within a 5 or 10 year period, but I don't need it to happen tomorrow. IRR is if you're a really more sophisticated investor and I'm stacking different investments, and some are going to be short term. I'm focused on the velocity of money. I might then focus more on that IRR metric rather than equity multiple.
So a 2x equity multiple could be over the span of 2 years, but it also could be over the span of 10 years.
Exactly.
And that time that elapses, there's obviously then 2 years. So if you double your money in 2 years, the IRR is higher.
Yeah.
So you'd expect a greater percentage IRR as opposed to the 2x equity multiple over 10 years, which it took a longer period of time to double your money. So in that 10-year example, the IRR would be lower than the 2-year example.
Exactly. IRR rewards shorter term holds and really disencourages longer term holds. And so again, you have that 2x equity multiple over a 10-year period. Again, the 2x might seem attractive, but the equity or the internal rate of return on that same investment might be 11%, 12%, might not look as attractive. But that same investment, it was a 5-year hold period, that IRR, even though the equity multiple would be less, you might be looking at closer to a 15% IRR.
Interesting. I'm starting to see the value of not just taking these independently of each other to evaluate a deal, but also using them together as a tool.
Yeah.
If I saw a deal that came across my desk that was marketed as a 5x equity multiple, well, that sounds awesome. But got to look at the investment period or the hold period. How many years or what amount of time needs to lapse or pass for me to receive that 5x equity multiple? It might be 25 years versus a deal that comes across my desk that's a 2x equity multiple, but the hold period is only a 5-year term.
Exactly.
One of those is going to be for me. One of them might not be for me, but the time component of IRR really is largely important to understand, but then pairing both equity multiple and IRR to make certain that investment matches my, as an investor, overall, lens for that or threshold or capacity to withstand that investment horizon, the hold period, and then it shares an alignment of interest with what I'm looking to, earn in overall returns and how long it takes.
Yeah, I think the key is exactly what you said, Griffin, is never using just one of these metrics, but using a combination of whether it's IRR, equity multiple, and the third, return metric that we really focus on, which is cash on cash return, which we can talk about at a later date.
Right. That'll be a late addition to the jargon bin potentially for next week. We're getting into deeper waters. Let's dive into the industry and veteran kind of realm of IRR. It's extremely sensitive, obviously, to the time that we're discussing. And so what aspects of the timing of a project would influence the overall IRR for that investment? You mentioned, refinance earlier. What else would be kind of encased into altering the timing of returns in an investment?
Any kind of early return of capital will significantly influence that IRR, positively. So again, whether it's a refinance, it's an early return of capital, and maybe if it's not even necessarily an early refinance, but any sort of return of capital within the hold period can have the effect of increasing the IRR. And so what investors need to just be mindful of when looking at those capital events, which can boost an IRR, how likely are those capital events to take place? So for example, let's say you have a 10-year hold period, but you've baked in a refinance in year 2, year 3, year 4, or maybe even year 5 at some point in the middle of the hold period. Well, that could be true, and that could be part of the business plan, and it could be appropriate. But you should look at it through the lens of, well, what if that doesn't happen? And if you remove that refinance, if you remove that capital event, you're going to see a significant reduction in that IRR or internal rate of return. So again, it can be used appropriately, baking in that refinance if that is, again, a core part of the business plan. For example, you're going in, you execute a value add, but it's not a short-term hold. You're looking to flip out on maybe a short-term bridge loan to a long-term, permanent loan, and there would often be a return of capital at that point in time. But again, that's all if everything goes well. If things don't go the way that they were planned and a refinance doesn't occur, or a refinance without a return of capital, that can significantly change the terminal return metric in the IRR. And so you just want to go and you just have to be nuanced and really understand what are all the levers that can influence IRR. An exit cap rate is another one, but that also can influence equity multiple as well.
Right. There's a lot of speculative nature to our industry and our investment strategies in general. We're looking 5 to 10 years, forward and trying to project, what revenue and expenses. And you talked about exit caps and potential refinances in the middle of a hold period. Is it? I don't want to say appropriate because I think it's not appropriate, but how often will investors or operators go through their underwriting model and try to solve for IRR in order to kind of financially engineer a deal that looks on the surface to be a little bit more palatable? And if so, if that's relatively high occurrence, what should investors be looking for in that regard? You're talking about refinances that otherwise wouldn't happen. Maybe it's a cash in refinance.
I just want to throw something else out.
Okay.
And all that is true, is worth noting. But where I see investors, I guess, making the mistake, and it can be solving for IRR, because it's like, well, what is your true goal? Is it income? Is it appreciation? Maybe equity multiple is more important. But the mistake I see more investors make is when they are using IRR as a comparison tool. And IRR is really developed to compare investments, just to figure out what their IRRs that are time-based. But when it's inappropriate is when you're comparing two different investments with two different time horizons.
Right.
So a 3-year hold, a 5-year hold versus a 10-year hold. You shouldn't compare the IRR of a 3-year hold and a 10-year hold. Clearly, the shorter term 3-year hold is going to have a significantly higher IRR. It might show a mid-20s IRR. It could be it could look like a home run, whereas the same deal, but it could be a 10-year hold, might show a 14, 15, or 16% IRR. And one might think that, well, the higher is always better. Higher rate of return in all cases often also means more risk. And so, it's hard to compare too. And sometimes that'll happen, if we have a project and we're walking through the deal with a prospective investor, and they may say, well, I'm looking at this other deal. Why is your IRR lower than this other deal I'm looking at? This one shows a 23% IRR, or all the deals I've done have been mid-20s IRRs, but you're showing me a 16. Why in the world would I do this low return deal?
Right.
And we have to explain, well, you were investing in short-term flips, 2 to 3-year holds. You're looking at a 7-year hold. It's really a different strategy, and it might be for a different goal. That's when you have to kind of dig into the details with investors, determine what are your goals. Are you looking for a high velocity of money, potentially higher risk? You want to go in, flip something, generate maybe a big IRR, maybe not a big equity multiple, but you're going to continue just to turn those deals, deal after deal after deal. That's a higher risk strategy. You can make a lot of money doing that, but it's higher risk. Or do you want to? I see as a more balanced approach, still being able to get a good IRR a healthier equity multiple, but taking a little bit lower risk. I think that's achieved by a longer hold period, at least 5 years. And so that's where I'm really looking more at what my equity multiple is. I want to at least double my money over a 5-year period, and I want to triple my money over a 10-year period. Those are my kind of general rules. What the IRR is, I personally I want to know, but I don't care nearly as much about how many times I'm multiplying my money. And I bring the time factor just into it by referencing a 2x over 5 years, a 3x over 10 years. Again, it's a simpler way to look at it, but there's just a lot less jockeying with, when a refinance occurs and there's a return of capital and, comparing a 34 IRR to a, 20 IRR, what's the difference?
Right. There's many more variables need to be considered when referring to IRR, especially when you're looking at a deal. We have investors here at Great Capital that will compare our past offerings and past investment opportunities and want to know, why this current offering is a, lower IRR compared to the last one. Why would you bring out another deal that was inferior to the previous one? And very often we have to, describe, well, the last one was a 10-year hold period. This one's a 7-year hold period or a 5-year hold period, just based on the term for the debt. So, just to kind of bring it all the way back around and kind of wrap it back into the most simplest terms, IRR is a speed metric of wealth creation and wealth generation, overall returns, while equity multiple is simply a wealth metric. Any other take-home messages for the viewers?
No, I don't think so. Well, I guess one is we didn't talk about for good reason, which is AAR, average annual return. And I'm not going to say it's a bad metric, but it's not our preferred metric. And just be careful that you don't confuse IRR with AAR, because there are some sponsors that will use AAR purposely to conflate with IRR, because your AAR, your average annual return, I don't even get into the formula for it.
Yeah.
It's simple, but it's there because operators, sponsors will use it when their IRR they think is too low to advertise to investors, and their ARR makes the deal look better than it really is.
Right.
And so you can have an AAR with 20, but the IRR might be a 14 or 13, and no one wants to come out with a 13 or 14 IRR deal because they think that it'll look like too low of return. So they'll use some. It's not a made up metric, but I think that at times it can be misleading at times because it's used because investors are thinking about IRR. That's my only other takeaway. And we can talk about cash on cash another time. It's a little more straightforward, but it's important to talk about.
I think that the last thing that maybe I want to throw in here is we've talked to,
So you're the one.
I know I'm the one that's causing problems, but I just have one last question for you. There are investors that want to see the bulk of an overall return come from cash flow.
Yeah.
And a significant percentage of that IRR coming from cash flow rather than maybe the speculative nature of cap rate compression on the back end, or overall NOI growth on the back end. Can you maybe briefly mention how IRR can become maybe misleading to those folks that are looking at cash flow just based off of the growth potential at the exit? And so I guess what I'm trying to get at is there are investors that are looking to retire, that are looking for that monthly cash flow, versus the investors that will invest in a project that has a high IRR because of growth, but maybe doesn't see as much cash flow on the end. How do those two investment strategies or potential models, how do they differ? And, I guess we're more prone to cash flow here at Great Capital. So talk a little bit about how the cash flow can impact overall IRR.
Well, the higher cash flow earlier on certainly will increase your IRR. And I think really what you're getting at is, what component is coming from, cash flow from operations, and which component is coming from capital appreciation.
Right.
We bought the property for $10 million. Now it's worth $20 million. And so how much of return is generated from, just from selling the property? And the reason why investors ask that is because it removes some speculation. It's saying how it's not how much can you sell it for, because you're speculating not just on what cap rates are going to be in 5 or 10 years, but also where you've been able to grow rents to be able to divide by a cap rate to come up with your eventual value of the underlying asset itself. And so let's remove some of that speculation, because you and I don't know what we're going to sell it for, but how much cash is it going to deliver? Now it can be difficult depending on your hold period to have 50% of the cash flow coming from cash flow operations. I mean, for a 10-year hold, you'd essentially have to at least be cash flowing. Just 5% for 10 years, we'll do it. Or if it's a 5-year hold, you have to be at 10% for 5 years. And typically, the deals that it's very rare to see that level of cash flow. Now, I would also say that cash flow, there's speculation in the cash on cash projections as well.
Sure.
Because, assuming you're not buying with an in-place, yield on cost going in at an 8, 9, 10% cash on cash return, often you're going in with a lower cash on cash return. You're executing a business plan, you're fixing up the units, you're operating the property better, and so you grow from, call it 5 or 6% cash on cash. In the first year, you're growing it to 8%, 9%, maybe even 10% over time.
Right.
And so there's a ramp up. But that ramp up involves speculation. It assumes that you've successfully executed the business plan. You've been able not just to renovate the units and not go over budget, but you've been able to release the units at your target rents. All of that, you can have a perfect execution on the rehab, come in under budget. But if you thought you were going to get $250 a month in rent premium and you only achieve $100 or $150, well, that ramp up from 5% cash on cash to 8% cash on cash may never happen, or may not happen at the same rate over the same time period that you originally projected. So I go and say all that. It's a good question to try to bifurcate cash flow and appreciation. It's also important to note that most business plans are speculative, and if you strip out, if you only look at a pro forma or a business plan and said, I don't want you to incorporate any cash, and this is it's untrended yield on cost, which it's a term that I do really like, because it's like, what are we actually buying here? If we bought it and we didn't do anything to it, we didn't grow rents, we bought it and let it go. What would it? We didn't even we didn't allow ourselves to grow rents. What would the return be? And obviously, if expenses grow and revenue grows, the return goes down over time. So it never looks good, but it shows you what your baseline is. And so the business plan is basically saying, we're going to take this untrended yield on cost, but we're actually going to do something. We are going to try to raise rents through just organically moving rents to mark to market, or we're going to add value, increase the the underlying and the perceived value of the property to achieve higher rents. Well, again, just nothing in life is guaranteed, and then it comes down to the strength of the business plan, the market knowledge. If you're already at the top of the market and you say you're going to raise rents another $100, maybe that's possible, but there might not be a data point other than maybe an income demographic to point to. If you're buying a property that is $200 below the rent of the property across the street, and it's the same style, same finishes, well, that's a pretty strong data point. I think you could probably at least raise the rents $100 and still undercut the guy across the street. So every business plan is nuanced. And the question about cash flow and appreciation is a good question, but it doesn't always it doesn't necessarily solve all questions, and it doesn't necessarily flush out what people want to flesh out. What it does tell you is just how much speculation is going on from the back end versus the front end.
Right. Understood. I think I asked that question primarily just to kind of pick your brain, but I think there's folks that ask us that question that are trying to maybe weed out or make certain that there is no refinance baked in, or that we don't have a speculative capital event in year 3 and year 7. And also, we do have existing investor base that does prioritize cash flow, and I think they just want to see that each deal that we're bringing to them does have robust cash flow. Returns.
One of the reasons why multifamily is such a favored investment, and the reason why I love it, is that it's really well balanced. Some investments are all about cash flow. Some are all about growth. Some are just about diversification. Multifamily finds itself in the sweet spot of being able to provide really stable cash flow that's durable. It's also very tax efficient. But also, there's a great opportunity to have capital appreciation and achieve a strong equity multiple. Now, I think it's smart when approaching, at least the way I see of buying apartments, investing in like existing assets, is you buy for cash flow. Especially, you're looking at what they've been able to achieve, and what you essentially your untrended yield on cost. Like, what are you going to get just right out of the gate, and then how can we make this better? How can we add to that cash flow? And look at your exit, look at the equity multiple, look at the IRR. But there's a saying, you can't eat IRR, and I can have a very strong feeling of where interest rates may be in 5 years, 10 years, in related to that cap rates. But like you need to raise your hand and say we can't predict the future at some point, and that's involves a higher degree of speculation versus my viewpoint on this particular asset, this particular market, at this particular point in time. Can we execute a business plan to achieve higher rents within 1 to 2 years? I'm more confident on that pro forma, and because the downside is like, well, maybe it took 3 years instead of two, not, oh, well, we thought cap rates would be 4.5 in 5 years, but in fact they are 6%. Because then the deal just doesn't work. But if I'm focusing on the cash flow itself, well, I can continue to cash flow a deal. I can cover my debt service. Typically, if there's healthy cash flow, that means I'll have opportunities to refinance, and I can control my exit point, especially if I have long-term permanent fixed rate financing in place.
Right. Makes a lot of sense. And that's why we see the deals that we do see coming through the Gray Capital investor portal is usually fairly robust cash flow in year one from day one of operations.
Yeah. And it's not as much, times have changed. And we were in a period when I got started that you could achieve 7, 8, 9, 10, 11% cash on cash year one out of the gate. Often there's interest only involved. Sometimes there was maybe a bridge loan to a permanent HUD loan because interest rates weren't flowing around. But that's because cap rates were more in like kind of had like a 6 handle on them. So you could get some real leverage, you could get some positive cash flow. As investors piled in, cap rates compressed, and eventually interest rates rose. You eventually saw those cash on cash margin decrease slowly over time. It's a little bit of boiling frogs. But instead of like coming out of the gate with 8%, now it's typically starting kind of at 5%, growing to 8% over time. And that's a reflection on a number of things. I mean, again, it's interest rates. Interest rates are lower. Cap rates are lower. And the reason for all of this is because there's just been an increased investor demand in multifamily. When office, we used to be the poster child of commercial real estate. If you invested in commercial real estate, it was office, 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 maybe a little bit of retail, maybe a little bit of industrial, maybe a little bit of multifamily. Now it's multifamily, it's industrial, and then a little bit of retail, and then office is this ugly-haired stepchild on the back that everyone's trying to figure out what to do with her. Was that an inappropriate description of the?
I think so. I think that's just fine.